Now, how do you trade sterling in the lead-up to the UK's referendum on its relationship with the European Union? And more importantly, what happens afterwards? In both scenarios, well, Nick Parsons is Head of Research, UK and Europe, and Global Co-Head of FX Strategy at National Australia Bank. Nick, welcome. Let's take a look, first of all, at the markets generally. As we lead up to this, we saw that low print for sterling back end of February when we heard all about the date for the referendum. Since then, money's gone back into sterling. How comfortable do you feel about where we are for sterling at the moment?
I'd say very uncomfortable at the moment. A lot of hedges were put in place February and March as corporates in particular sought to protect themselves against the possibility of a sharp decline. Now, as the opinion polls then tended to swing towards the Remain camp, and as all the heavyweights came out from President Obama downwards to warn of impending doom, gloom, death, war, disaster and plagues of locusts, so we saw the pound rise, and we're about 8 or 9 cents at one point off those lows. So we have been back up to 147, but I think at 147 the market to me seems a little too complacent. I think it's much closer than the markets appear to believe. And you only need a couple of percentage point swing in turnout to get dramatically different outcomes in terms of the overall result. And so I think at 147, if we can get up to that level, that is really going to be the extent of sterling's pre-referendum rally.
You're talking there about pound against the US dollar. What about the pound against the euro? Because we're talking here about the UK's relationship with the eurozone, which we're told is so important.
Well, if we go back to November, December of last year, the pound was trading above 140 against the euro. We came down to around 120. The end of February, early March, and we're now, as we sit, around 128. Now, we hear a lot from the Treasury and from the Bank of England and from many learned sources about the instability that will come to the UK economy as a result of an exit vote that causes the pound to plunge. And I'm afraid it's here that our analysis differs quite markedly from the Treasury and the Bank of England, because we agree that the pound will fall against the dollar. If we assume an exit, then I think we're going to see 128, 130 for the cable rate. So 128, 130 for cable, but I think that the pound's fall against the euro won't last more than 24 hours. I think the initial reaction on an exit vote, a leave vote, will be just simply to sell the pound indiscriminately. I think we could see the pound, which is currently now 128, down at 120 against the euro. But within a matter of hours, days at most, I think we'll be back up nudging 140. And the reason for that is if the pound leaves the euro, it's more of a crisis for the euro than it is for the UK. There's an existential threat to the euro, which I think the markets will pick up on very, very quickly.
That is a phenomenal stretch from bottom to top.
Yes.
That is enormous. You're saying this is all going to happen within the week?
I think it could happen by Monday or Tuesday morning. If we have a vote to leave, I think the pound could fall 10 to 14 cents against the US dollar, a 10% decline against the dollar. We're thinking of a 5 to 6% decline against the euro immediately, simply because the first reaction is sell sterling. And that would make sense. Okay. You shoot first and ask questions later. You sell sterling. And once you've sold sterling, what's your next trade? It's, well, for heaven's sake, it's sell the euro. And I think sterling will come bouncing back like a bungee cord. And I think we'll see a bungee jump for sterling, which will end up stronger against the euro in the event that we leave. And that's where we differ.
OK, let's flip the result. 24th, we wake up, we're in. It doesn't really matter necessarily what the margin is particularly, but let's say we're in. Big relief.
A bit of a relief rally. I think the template for that is probably the Scottish referendum. We went up 3.5 cents in the morning after the Remain vote in the Scottish referendum. And the morning after the vote was the high that we subsequently saw for sterling for the next 3 or 4 months. In other words, yes, we had a relief rally, but then what? There were lots of issues, lots of political concerns. I think we may well get a relief rally in sterling in the event that we remain. But let's remember the Prime Minister's got a 17-seat majority. Yeah. Europe as an issue is not going to disappear for the Conservative Party. All the investment that was put on hold in the first and second quarters of this year is not suddenly going to come piling into the UK on the 25th of June. So we're still looking at a weak and fragile economy. We're going to be a dark cloud of political risk hanging over sterling, and we think the relief rally is probably going to be limited both in scale and in duration.
Let me turn the attention now on to one of the most traded pairs around euro-dollar. What happens to euro-dollar in this event? Let's take the exit, the surprise exit vote. We're out of the European Union. What for the euro against the dollar?
Well, let's do the simple maths, and my maths will keep up with this one. If we're right that the pound goes to 128, and if we're right that the pound also stays around settles around the 128 area, that gives you a euro dollar of parity. I can divide 128 by 128.
Okay, that's this dotted red line down here.
So euro dollar at parity is, I think, what would happen in the event of an exit for the UK, because it's as big a threat, if not more of a threat, to the single European currency than it is to sterling.
And then a big snapback?
No, not particularly.
So maintaining.
I think it would maintain those kinds of levels,
right,
because you'd be asking yourself, what do you want to hold? And the answer would be, well, I don't want to hold euros, I don't want to hold sterling. The dollar by default would then be rising. And I think the dollar would be able to sustain those gains around parity.
Implications for that, emerging markets, Japanese markets, phenomenal implications.
Phenomenal implications, none of them, or few of them, good. I think it would lead to a big increase in volatility, which itself is bad for markets. I think it would lead to massive economic uncertainty, which again is bad for markets. And if we look at some of these markets, let's take the S&P 500, for example, which is within 30 points of an all-time high, you've got to say worries about corporate earnings against a more volatile economic background would even leave a benchmark like that looking somewhat exposed. So we think, the dollar would rise, and it would have all those sorts of negative things that we were worried about, remember, at the start of the year. The rising dollar putting pressure on emerging markets, putting pressure on corporate earnings, and putting tension into the monetary system. We could be in for a rerun of that one.
Okay, all right. Look, it's a fascinating subject. Nick, thanks indeed there for joining us. Nick Parsons there from National Australia Bank.